Ladies and gentlemen, good day and welcome to Pearl Global Industries Limited Q4 and FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pallab Banerjee, Managing Director of Pearl Global Industries Limited. Thank you, and over to you, sir.
Thank you. Hello, this is Pallab Banerjee. Hello, everyone. Good morning. Welcome to our Q4 and financial year 24 earnings conference call. Along with me, we have our Group CFO, Sanjay Gandhi, and SGA, our Investor Relations advisors. I hope all of you have had a chance to go through our annual results and the investor presentations uploaded on the exchange and our company website. Our outstanding performance for fiscal year 2024 is a proof that our strategies are working and a testament to our competitive advantage as a global manufacturer. Our sustained growth, despite being one of the difficult year, is driven by leveraging our core strengths of multi-country presence of products in market design expertise and strategic customer relationships. This growth primarily stemmed from increased orders from our existing customers, yielding better relationships, as well as value-added sales from the customers which we acquired over the last 5 years. Let me start with an overview of the industry. The global textile and the apparel market is projected to be relatively flat this coming year due to various macro factors, uncertainties, and volatile geopolitical reasons. Western country major players are being cautious due to the various elections which are scheduled this particular year, while the Asian economies continues to march ahead a little bit more sustainably. However, these developing Asian economies are also confronted with challenges such as escalating labor and production expenses in major manufacturing nations, prompting companies to relocate their production to more cost-effective locations. Additionally, the volatility in raw material prices poses some certainty challenges for us, but nonetheless, there are enough opportunities in meeting and overcoming and with this evolving consumer preferences for eco-friendly, sustainable, and organic materials, as well as in capitalizing on the rapid expansion of e-commerce, which broadens the accessible marketplaces for apparel brands and the retailers. Now, the Asia-Pacific region dominates the global textile and the apparel market, primarily due to the significant presence of key manufacturing nations. Among these, China remains the largest textile producer and consumer, while India is emerging as a rapidly growing economy for both export as well as consumption. Other notable performers include Vietnam, Bangladesh, and Indonesia, where our operations are very well established. Throughout the previous year, the industry encountered several challenges. These included persistent geopolitical tensions globally, which impacted industry operations, particularly in global trades, where demand saw significant fluctuations, and this disrupted the international trade as well. These circumstances have had a notable influence on the Indian textile sector as well, particularly those segments which are heavily dependent on the exports. Now, if I talk about US, all the retailers and brands have effectively bounced back from the excess inventory situation which they experienced last year. Moving forward, we expect to see a gradual enhancement in the consumer confidence as well, highlighting the resilience and the robustness of not only the U.S. economy, but also other worldwide economies as well. However, the industry captains are playing very cautiously optimistic approach. Due to the upcoming elections, end of this particular year, they want to be close. They actually want to buy close to the selling season to avoid over-inventory situation once again. Thus, they are preferring the near-shore and the faster transit options. For us, now the faster transit options from the manufacturing countries, I mean. Now, the Red Sea adverse situation is not in favor of this particular strategy. However, for us, there is no effect of cost for the Red Sea situation that we are facing since last 1 year, because all our shipping are in FOB terms. As long as we can deliver the goods faster, they need actually 1 week early, so that the extra time that is needed if they have to go through around the African continent. So that's 1 week is definitely expected from us, that we deliver faster. Now, our manufacturing setup in Guatemala, where transit time to USA is just about a week, is getting more and more queries and lots of interest from these customers. However, the capacity in Central America is limited and would be just a fraction of what we have in Asia till date. Other markets like United Kingdom and European Union are still going conservative. However, I must say that the successful retailers and the strong players are strategizing themselves to achieve a better results than the forecasted macros. If I talk about Australia, Asia and Japan, these markets are relatively upbeat. Most of them have come out of the COVID lockdowns only in 2023, especially like if we talk of China and the Australia and Japan market also, we saw the momentum started coming up only in 2023. And these may be relatively distanced from the geopolitical tensions that we see causing a direct impact on the Western economies. Now, if we continue, for us, we will continue to increase our Bangladesh operations, looking at several advantages that we have there. It has readily available a very stable, skilled workforce, experienced middle management, and a very strong ecosystem of banking support, improving logistical infrastructure that is happening in that country. And above all, they have some favorable trade agreements. This enables us and our manufacturing operations to uphold the high production standards and meeting of the service levels that is demanded by our customers internationally. And we can do it with ease. With regards to the wage hike in Bangladesh that we experienced end of last year, which we discussed also in our last quarter call, the increase in Bangladesh wages, if you remember, would create an impact between 12 to 15% of our wage bills. Overall, from a profit and loss perspective, it changes by approximately 1 to 1.5% when we compare it to the top line. Now, we had already planned to overcome this challenge through automation and efficiency improvements. The current devaluation that happened in the Bangladeshi taka, which took place recently, is an additional help to us. In Vietnam, we will continue to grow, however, at a relatively steadier pace, like whatever you have seen in the last 3 to 4 years, the kind of pace that we had. We will continue to grow there, but with a relatively steadier pace, and continue to service our higher-end customers. Indonesia will gain back its numbers. These were down over the last 2 years when we were building and shifting to our new facility away from the seashore. If you remember, we had, because of global warming, it was definitely the seashore is not a safe place to run a factory. In India, we enhanced our existing capacities in the states of Haryana, Karnataka and Tamil Nadu over the last year. And going forward, you will see us investing and starting production in other states as well, where we find there are availability of trained labor force and is relatively less expensive than our existing production locations. We will plan to further automate all our facilities and all our processes, maximize the use of existing capacities and expanding them. We will continue to invest in improving our operations, implementing stronger governance processes, digitization of all our factories, and improving our financial rating. We are already aware of our dividend and capital allocation policies. We already have announced our strategic plans and objectives for 2028, and we feel that we are marching solidly on track. We will continue to add and grow with customers who are getting stronger in the world market. We will stay away and decrease our exposure for anyone which is becoming financially weak or we feel they are risky. You will see us continuing to enhance our achievements by exceeding our past records of revenue, capacity, efficiencies, and thereby directly enhancing our bottom line profits. We are dedicated to each of these objectives through the strategies that we shared with you in February meeting in Mumbai, which involves expansion plans, marketing and designing focused product categories, strengthening our strategies with the current customer relationships, and increasing the wallet share, how much they're spending with us. So in a nutshell, this is what we have for you. Now, I would like to hand over the call to Mr. Sanjay Gandhi, our Group CFO, who will provide you with the insights on the financial performance. Sanjay, over to you.
Thank you, Pallab. Good morning, everyone. I am delighted to announce yet another strong year for our company, marked by remarkable financial and operational achievements at the group level. Starting with consolidated financial highlights. I am pleased to announce that for financial year 24, on a consolidated basis, our revenue has increased by 8.8% year-on-year to INR 3,436.2 crore versus INR 3,158.4 crore in FY23. This growth was achieved on the back of our overseas revenue, which witnessed a growth of 21% year-on-year. For Q4 FY24, revenue grew by 20.2% year-on-year and stood at 877.4 crore. For FY24, we are happy to share that we have crossed INR 300 crore mark with respect to consolidated adjusted EBITDA and reached INR 316.4 crore, which is a growth of 22.5% year-on-year compared to INR 258.2 crore in FY23. Please note that adjusted EBITDA excludes ESOP expenses of INR 8.6 crore in FY24 and INR 2.7 crore in FY23. Going ahead, considering same allotment, ESOP expenses for next year will be in the range of INR 4.5 crore to 5 crore. For Q4 FY24, adjusted EBITDA witnessed a growth of 30.8% year-on-year and stood at INR 83.9 crore compared to INR 64.2 crore in Q4 FY23. This excludes ESOP expenses of INR 2.5 crore and INR 1.4 crore in Q4 FY24 and Q4 FY23 respectively. Furthermore, our adjusted EBITDA margin saw a year-on-year improvement of 100 basis points, rising from 8.2% in FY23 to 9.2% in FY24. The enhancement of operational efficiency notably contributed to increased revenue in Bangladesh, fostering economies of scale and subsequently boosting the EBITDA margin for our international operation. For Q4 FY24, we have witnessed 80 bps improvement in adjusted EBITDA margin, which grew from 8.8% in Q4 FY23 to 9.6% in Q4 FY24. PAT for the year stood at 169.1 crore versus INR 153 crore in FY23, which is a growth of 10.5% year-on-year. However, if you look after PAT, after minority interest, it stood at INR 174.8 crore in FY24 compared to INR 149.3 crore in FY23. For Q4 FY24, PAT after minority interest stood at INR 51.3 crore in Q4 compared to INR 51.9 crore in Q4 FY23, which shows a degrowth of 1%. However, there was an exceptional gain of INR 17.8 crore in Q4 FY23 and INR 13.5 crore in FY23. Excluding that, we have seen a good profitability both for Q4 FY24 as well as financial year 24. EPS for FY24 grew to INR 40.26 per share in FY24 versus INR 34.45 per share in FY23. Coming to standalone financials, revenue for the year stood at INR 953.7 crore versus INR 1103.8 crore in FY23, a degrowth of 13.6% year-on-year. The decline is mainly because of low sale volume in net business. One major reason for such decline is the business transition to Bangladesh. For Q4 FY24, revenue stood at INR 320 crore, which is a growth of 16.6% year-on-year, compared to INR 274.6 in Q4 FY23. The growth witnessed was due to increase in the woven business. Adjusted EBITDA stood at INR 49.3 crore. Adjusted EBITDA margin stood at 5.2% in FY24 compared to 6.4% in FY23. The margin pressure was due to employee expenses and other expenses being fixed in nature, thus negatively affecting EBITDA with decline in revenue. For Q4 FY24, adjusted EBITDA stood at INR 20.6 crore with adjusted EBITDA margin at 6.4%. PAT for FY24 stood at INR 28.2 crore, whereas Q4 FY24 PAT stood at INR 11.9 crore. While numbers for current financial year 23-24 for standalone have shown degrowth and drop in profitability, we continue to work on capacity expansion in existing factories and also look for suitable opportunities in other states in India on the backdrop of customer acquisition, increase in wallet share, the strategy which put in place in financial year 23-24. We are confident of improved performance on a standalone basis as we start financial year 24-25. Our strong performance at a group level is reflected with our strengthening balance sheet. On a consolidated basis, our gross debt is similar to last year level of INR 445 crore in FY24 versus INR 448 crore in FY23. Net debt to EBITDA stand at 0.25 times for FY24. Return on capital employed improved from 24.2% in FY23 to 28.2% in FY24, which is a growth of 400 basis points year-on-year. The return on capital employed has improved due to profitability in overseas market, prudent capital allocation policy, and efficient working capital management. Margin money earmarked at LC payment is excluded from capital employed calculation. We have used net debt to arrive at above stated return on capital employed. Net working capital days decreased from 38 days in FY23 to 30 days in FY24. Debtor increased to 28 days in FY24 from 24 days in FY23. Inventory days decreased to FY23 in FY24 from 59 days in FY23. Creditor days increased to 52 days in FY24 from 45 days in FY23. On a steady-state basis, with the growth in the business and the customer mix, we believe that net working capital days around 35 days should be a stable state for us going forward. To add to point of BD wages, Bangladesh wages, and its impact on profitability, to update the recent development in the month of May, Bangladesh Bank has unveiled the crawling peg exchange rate system and allowed bank to buy and sell US dollar freely nearly Taka 117. A crawling peg system is a method of exchange rate adjustment that allows a currency with a fixed exchange rate to fluctuate within a band of rates. It's a hybrid of fixed and floating exchange rate system. Central Bank in Bangladesh has also disbanded the smart formula to make interest rates in the banking system fully market-based linked thereafter. Central Bank announcement were in light of the conditions set by the IMF. During the year, we have incurred a property, plant and equipment capex of INR 115 crore and additional INR 1.25 crore approximately towards other IT-related capex. CapEx of PPE, property, plant and equipment was incurred across geographies for growth, upgradation, automation and leasehold improvements and also replacement. In India, we have incurred a CapEx of 42 crore, where 50% was toward the growth CapEx and 50% toward maintenance and leasehold improvement. In Bangladesh, the total CapEx was incurred 40 crore, where 55% was toward upgradation and automation and 45% toward maintenance and leasehold improvement. In Indonesia, we have incurred a total CapEx of 16 crore towards capitalization of the building from CWIP. And so, in effect, this is also a growth CapEx. In Vietnam, we have incurred a total CapEx of 13 crore, of which 5 crore was toward automation and INR 8 crore was building improvement. In Guatemala, we have incurred INR 4 crore towards growth CapEx. As you are all aware, we have a dividend policy in place where the company will declare dividend of at least 20% of consolidated profit after tax in a given year to the shareholder. We are happy to share that in the fiscal year FY24, we distributed a dividend amounting to INR 38.1 crore, which is 22.5% of our consolidated profit after tax. Going ahead, with a robust performance in FY24, coupled with a strong and diverse customer base and geographical presence, we are well positioned for a strong performance in the coming years and are well on track to achieve our stated guidance for financial year 28. Thank you. We shall now open the floor for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Hemant Shah from Seven Islands PMS. Please go ahead.
Hi, good morning and thank you for this opportunity and congratulations Pallab and team for the fantastic numbers. I have two broad questions, Pallab. I think February FY24 presentation says that we are on track to achieve almost 6,000 to 6,200 crore of top line by FY28, as even the CFO reiterated in his comment. So just wanted to check, considering the slowdown you face this year and some futuristic, inorganic or organic growth is in mind, or I'm just trying to gauge how we are planning to achieve this 6,000 crore of top line by FY28, and are we on the track to achieve it and how? And just broad overview about it, please.
Yeah, thank you. Thank you, Mr. Hemant. Very valid question. And I was just mentioning in my, speech that we are solidly on track on this strategy that we presented to all of you in the month of February. The strategy remains exactly the same. We are focusing on the customers who will give us the top tier customers, like who will give us the maximum revenue, then the second tier customers who will continue to grow with us, and then the other tiers, like where we are adding continuously our new customers and executing the business of the current that we have. Of course, with all the things that is happening in the world, we continue to always very closely watch the performance of our customers as well. Like anywhere we find risk, then we start decreasing the volume there. And wherever we find the strength, our focus and energy is more towards those guys who are performing well. Mm-hmm. In terms of the numbers that we have talked about, we are, as I mentioned, solidly on track. We were confident that this particular year, 2024, we will be ending up with the growth. May not be like the 15% or 20% that we talk about as a CAGR level, but this was an exceptional year. That's why there is a little bit of drop, but still we have closed around 9%. And I think if you can do some comparison with some of the other industry peers, we are definitely can't say that we are going weak. We are becoming stronger only. And naturally, the play that we have in terms of both growing the capacity, growing the wallet share with the customers, I think all of the strategies that we have discussed and highlighted in February, we are on each one of them, I would say we are solidly on track.
Great to hear that, Pallab. So basically, barring FY24, I mean, we can comfortably expect at least 15 to 18% CAGR growth, right? So with that, I mean, for FY27, we can definitely expect almost over 5,500 crore of sales. And as you mentioned, the EBITDA should be in the region of 10% or so, correct?
Yes, because you see, as the number goes up, we are not, in this whole plan, we have not talked about any acquisition of a new business.
Okay.
This is the organic growth that we are doing with the kind of infrastructure that we have. Only thing that we are adding are the new facilities to this plan. Of course, we will always be open if some other opportunity comes up, we will look into that. But this particular plan that we have, we are, I think, solidly on track. And as the number goes up, always there are operational efficiency that builds up. So that gives us that, the confidence also in terms of the bottom line performance that we have been promising all of you. So that number continues to improve.
Great. Fantastic to hear that. Lastly, with this respect to this only, with this existing infrastructure, what kind of revenues, optimum revenues we can generate, I mean, as of today, barring the expansion which we are planning in the next 2-3 years or so to reach almost 6,000 crore, I think we need to invest something. But with the existing infrastructure, what kind of revenues and what kind of sales we can generate?
Yeah. So if you see, if we go back 1 year or 1.5 years, we had the current infrastructure that we had, we could maximize it towards 80 million pieces of production.
Right.
Now, as I speak to you today, this is enhanced already to about 84 million pieces approximately. So this number, so even the year was tough, but we didn't change the plan because you see, we are continuously in touch with our strategic customers, how they are thinking, what are they are planning for the next 2 to 3 years. So that conversation is always solidly on. So with that, we have not stopped in the background our enhancement capacities with the existing infrastructure that we have had. And then, this particular year, as I mentioned, in India, wherever we had the factories, so we are definitely maximizing those capacities and building up to be ready as the business goes up, we should be able to service it well. Because in India, we don't have so much of partner factory, but yes, we are continuing to try and get some partnerships as well. So that is happening in India. Now, going forward, we are seeing a good opportunity because of the government initiatives and all. We can open up some facilities in the other states where the availability of the workforce as well as the cost is better. Similarly, if you talk of all other regions, in Bangladesh, we have strengthened the current capacity utilization and also the partnerships that we have already out there. At the same time, we continue to look for opportunities to grow and acquire more factories. So that will continue to happen. Vietnam, we already have a good capacity because of our own factory as well as the partnership factories. We continue to grow that number on basis of the capacity already we have as we utilize more and more. In Indonesia, we had the change, in fact, we had shut down one of the factory and we built up a new factory, more inland. So that has now complete, numbers will just go up there. So that capacity, no change out there. But Guatemala, the capacity has added in this last 1 year. So if you see, that's how we have got from 80 to 84 already, or towards our path to become 120 to 140 million kind of capacity that we should be having for 2028, how we have planned.
Wonderful. And lastly, with respect to this only, will there be any per unit improvement in realizations going forward? Because I think we are adding a good value-added production in Vietnam and I think even Indonesia, right? The high value, high margin products. Low volume.
I feel that's something, yes, always our endeavor would be to get to a better UVRs. But when we do the projections, like what we have shared with you in February in Mumbai, that's something we are not even adding those benefits. If that comes, those benefit comes, it will be additional. So we are still taking, like, because you see, like in our industry, always there is a variability in terms of raw material cost,